So this question is about options, European all options. So we have given the following information. We have a long position on 190 June Japanese yen European call contract. And at the expiration, following spot prices transpire, or assuming that following spot prices transpire, what would be the value of long position under these circumstances? So for each of these cases, we are going to determine what will be the value of the contract that we have with these conditions when the June contract expires. We will ignore the time value, and I will explain what we mean by this, which simplifies the calculation a little bit, but there is, this implies that there is actually a time gap between the time that we pay the premium for the option and the decision that we make whether we exercise the option or not. So we can ignore that and assume that the premium that we paid at the time of expiration has the same dollar values and do the math based on that. But in reality, if we paid the premium 3 months ago, we need to actually account for the time value of that premium at the expiration. So in this particular case, we will ignore that and do the calculations based on the same dollar value. So first, let me explain what the contract features are signaling in here. 90 is actually the US dollar units that we are going to be paying at the exercise if we decide to exercise. So essentially 90 is the exercise price in dollar forms, but that does not mean $90, that does not mean 90 cents, but it means $0.0090, or you could think of this as 90 cents per 100 Japanese yen. So this is a contract feature, and this is very peculiar for the Japanese contracts. In order to make the communication easier, the traders in the option market and the futures market adopted this principle where they express the exercise price or the contract prices in cents per 100 Japanese yen. So essentially, we are talking about here, as I mentioned you, 0.0090 US dollar per Japanese yen. Let me write this down so that we become clear about it. I'll write it in this text box here. 90 implies $0.090 per Japanese yen. So essentially, this is going to be the exercise price per Japanese yen. And the prices that we listed in here, for instance, 81 implies dollar 0.081 and 85 implies dollar 0.085 and so on. So this is what you mean with these prices. Okay, so these another way just to see that when we see 90, actually to get the actual dollar price, we need to take the 90 itself. So in terms of dollars, this is going to be 1 over 10,000. Again, it's the same thing as 0.0090 dollars. Okay, so essentially 10,000 of this value is the exercise price. Very similarly, you see the contract prices or premiums, option premiums in the second column. These are the premiums for call options. On the second column, you see the premiums for the put options. For instance, 2.11 implies 2.11 divided by 10,000 per Japanese yen, or you could write this as 0.00211 dollars. So this is the price of the contract per unit of Japanese yen. So let's say if you're going to be buying the call option, 89 call option with June maturity, the price per unit yen is going to be 211. So in this case, since we are dealing with the June Japanese contract for June, the contract price or the premium is going to be 147. So 147 implies $0.00147 per Japanese yen. Okay, so these are some of the contract features that we can extract from these prices. This is a typical representation of these contract prices. As you've seen here, September contracts prices for the calls are listed in here. There is a feature of the call options. The call premium declines as the exercise price increases. As you've seen here, 89 has a higher price. As we go up in the exercise price, the premium declines. The larger the exercise price for the call options, the lower the premium is. Same for the September option. And when we compare the June and September options with the same exercise prices, you see also that the longer term contract is worth more. For instance, September contract with 89 strike price is 3.15 or $0.00315 versus the June contract, which is $0.00211. So for the options, regardless whether they are call or put, the longer the maturity, higher the premium is. But for the call options, the higher the exercise price, lower the premium is, as you see in this case, in this column. But for the put options, just the opposite. As the exercise price goes up, as you see in here, the premium is increasing. This is simply because of a simple feature of the call options. I'll just write this down in here. So for a call option, intrinsic value is maximum of spot price at time t, or the expiration, minus exercise price. Let's put it this way, and 0, right? So this is the case for the call option in terms of intrinsic value. So if you look at this in here, as for a given spot price, sorry, this should have been times 0. So this is the spot price as of this time, which is actually given as 90.94. Still, again, 10,000, so 94. The call intrinsic value is maximum of spot price minus exercise price, or 0. So as we increase the exercise price, as you've seen here, the intrinsic value is going to decline. Since the call value is equal to the intrinsic value plus time value, regardless of what happens to the time value, with an increasing exercise price, the call premium should be declining, right? Since this part is going to be going down with increasing exercise price, the call premium will go down. In contrast, for the put option, the picture is slightly different. In the case of put option, the intrinsic value is exercise price minus the spot price at that particular time, or 0, and plus, of course, a time value. So with the increasing exercise price, the intrinsic value should be increasing for the put option. Therefore, we have this relationship. Okay? So these are some preliminary concepts about options. Just to review again, the first one is about how do we read these prices. This is a peculiarity of the Japanese yen contract, as I mentioned you, for exercise price, for instance, 90 June Japanese yen call option means that the exercise price is actually $0.0090. And then we are going to evaluate these contracts for these final or expiration spot prices of 81, 85, 90, and 99. So this is essentially a scenario analysis. Let's say we have the contract that gives us the right to purchase Japanese yens at $0.0090 at the expiration, and then these possible prices transpire, and then we're going to make a decision whether we're going to exercise the option or not. So let's move on to the next slide. Before I do that, though, I need to clean these up because it is going to carry on to the other slides. So let's move on to the next slide. So in the next slide, again, we have the information in here. How we are going to calculate the net value. Net value is indeed equal to the value of the option at the expiration minus the premium times the number of contracts that we have. Because of the peculiarity of the Japanese yen, we have an additional term in here to appropriately calibrate the price. We also multiply these, the exercise spot price and premium by 1 over 10,000 so that we get the actual dollar value. And this last one is the units of Japanese yen in one June contract. So this is actually a feature of the Japanese yen contracts. In this particular case, each contract, each option contract has 1 million units of Japanese yen. So let's first look at the decision rule. If at the expiration, spot price that transpires smaller than the exercise price, then the option is worthless because the contract that we have gives us the right to purchase the underlying currency, which is Japanese yen, at the rate of, let's say, 0.090. But in the market, the price is 0.081. So it would be unwise for me to exercise the contract and purchase Japanese yen at the price of 0.090 while I can purchase it in the spot market at 0.081. So obviously, in that case, I'm not going to exercise the option. So option is going to be worthless. The contract actually is not going to be used. The term that we use for this is that the option expires and is not exercised, so it goes unexercised. In that case, the value associated with the option is 0 because of this condition. And net value is composed of the premium that we paid for the option. So if you look at this top line in here, this part is actually 0 because ST minus E in the case of, let's say, 81 and 90, 81 minus 90 is negative, and maximum of a negative number and 0 is equal to 0. So this part drops to 0, and then we have the premium, and then we have all the other factors as 10,000 times 1 million to calculate the net value. So the net value in this case is going to be minus $147, which is the premium that we paid. As you see in here, the premium, which is 1.47, is actually in dollar terms 0.00147. This is per unit of Japanese yen. In contract, we have 1 million Japanese yen. Therefore, the premium that we paid actually at time 0 when we purchased this contract was 147. So our position now is worth minus 147. This means that practically we ended up by losing $147. So that is the case when the price turns out to be 81. What about 85? Well, nothing changes if the contract, the spot price turns out to be 85. Still, we have this condition, that is, the spot 85 is smaller than 90. Therefore, this first part again is going to be 0. And then the premium that we paid is still there. Therefore, the value still is going to be minus 147. The option is not going to be exercised. Therefore, we're going to incur the cost that we paid, the premium that we paid for this option. The third case where the contract price, the spot price turns out to be 90, this is the case where we could be indifferent between exercising and unexercising or not exercising. In this case, even if we exercised, this first part is going to be 0. If we do not exercise, again, it's going to be 0. So still we incur this $147 loss. So up until the spot price exceeds the exercise price, a call will not be exercised. So now let's look at the 95. What happens when the spot price is 95? Now things change. At 95, it means that we could actually use the contract, purchase Japanese yen at 0.090, and then sell it in the spot market for 0.095. That means that there is actually value in the contract. So the net value then in this case is going to be a non-zero first part. This part now is actually worth something. So there is actually a $500 value that we capture in here. But since we paid the $147 premium, the net value that we would have is going to be $352. So if you plug the numbers in and do the math, you're going to get this $353. What about 99? If the spot price turns out to be 99, still I will exercise the option, go ahead and purchase Japanese yen at 90, sell it in the spot market for 99. That would just give me a profit of 753 after the premium that I paid, which is 147. So in this case, exercising the option has a $900 value, but since I already incurred the sunk cost of $147, my net value is going to be $753. So this is the case for the June contract. Next question is asking the same thing. The only difference is that this time we're going to consider the September call contract. So everything is the same. This time we are going to use the Japanese yen 90 September contract. If you look at the September contract, call option is worth $260 or $0.0000260 per Japanese yen. Obviously, since the premium is larger now, the sunk cost is larger and everything is going to be calibrated for a larger sunk cost. So let's see how the numbers pan out. In this case, the same principle in here as you see in here. The premium that we pay is $260. I have here a quick note for you that the option premium is a sunk cost. Regardless if we exercise the option or not, this cost is incurred, so it is not going anywhere. So we will have to account for this whether we exercise the option or not. So with similar characteristics at 81, 85, and 90, the option is not going to be exercised, and in these cases we are going to incur the $260 of sunk cost that we already paid at the outset to purchase the call option. But at 95 we are going to clear again $500, but this time since the premium is larger, the net amount that we get is $240. So net value of the contract for the September is $240. And again, for 99, again, we're going to clear $900, but the $260 contract premium that we paid will bring our net value to $640. So very similar calculations, just as an exercise. I think it will be good just to repeat the same thing. So let's move on to the next question. With this. So this question actually is sort of covering the basics of options when we exercise the option, when we don't exercise the option. So for the calls, whenever the spot price is lower than the exercise price, we do not exercise the option. For the put options, is indeed just the opposite. That is, you exercise the option as long as the spot price is lower than the exercise price. Because in the case of a put option, you have the right to sell the underlying currency at the exercise price. So if the spot price is lower than the exercise price, it would be wiser just to go ahead and exercise the option and pick up the exercise price instead of the lower spot price. So let's look at this time to a put option just to implement the concept. So in the same table, the Japanese yen table, we are going to look at this time 90 Japanese yen September European put contract. Again, we are going to evaluate the contract with the same future spot prices. Like in the previous questions, we are going to ignore any time value effect in here. So as I mentioned you, the net value in this particular case is it will depend on the maximal exercise price minus spot price at the time of expiration and 0. So if this is a positive, then we're going to pick that up as the option value. If this is a negative, obviously it is going to be 0, and then we will have to subtract the premium regardless. So in this particular case, put option premium is 180. That implies actually $0.000180 dollars per Japanese yen, as you see in here. So we will do the math based on that. So if the spot price is smaller than the exercise price, obviously option has a larger value because this part is going to be non-zero, and we will subtract the premium from that and calculate the value accordingly. So for instance, in the case of 81, the E minus ST is going to be 90 minus 81. We're going to subtract the premium, which is 180 in this case. We're going to do the adjustment for the Japanese yen, 1/10,000th of it in dollar terms, everything that goes on in here. And then we're going to multiply that with the number of units of Japanese yen in the contract. That will give us a $720 net option value. So this part is actually a $900 value, but since we are paying $180 for the premium, 900 minus 180 is equal to 720. In the case of 85, this time 90 minus 85, which means a $500 value minus $180, which is going to give us $320 net value. But after that, the put option is not going to be exercised. As a result, the net value of the contract is the sunk cost, which is the premium that we paid, which is $180. Okay, so this is the option put option version of the same problem, and again, it illustrates the put option and how we treat the put options at the expiration. So in this question, still we are dealing with the Japanese yen. Most of the questions in the book are on Japanese yen. We are assuming that the Japanese yen is trading at a spot price of 92.04 cents per 100 Japanese yen. We are assuming that the premium of an American call option with a strike price of 93 is 2.10, which implies actually $0.000210 or 2.10 cents per 100 Japanese yen. We are asked to calculate the intrinsic value and the time value of the call and put options under this case. So here there are two options involved. Strike price is 93. Call option with 93 strike price is trading at 2.10. The put option with 93 strike is trading at 2.20. So there is a slightly higher put price as compared to call price. There's an interesting relationship that is called put-call parity. So some parameters determine this relationship between put and call values that are essentially the interest rates. So in this case, we are going to calculate the intrinsic value of the intrinsic value and time value of the call and put options. Just as a reminder again, let's write down what the call and put prices imply. So the let's make this a little bit larger. Call premium is equal to intrinsic value plus time value. So what does this mean? The call premium then is equal to intrinsic value is the maximum of, we wrote this before, in the case of call option for at any given time t, the difference between ST and the E, which is the exercise price, and 0, right? So this is the intrinsic value plus there's a time value. Now, what is intrinsic value? What is time value? Intrinsic value is the value of the option, assuming that we exercise the option instantly at that time. So, for instance, at this point, spot price is 92.04, the strike price is 93. What would be the intrinsic value of the option if we exercise at this point? Well, for a call option, when the spot price is less than the strike price, the intrinsic value is actually 0, because this part is going to turn out to be negative, and between a negative number and 0, the maximum is going to be 0. Therefore, intrinsic value of this option is actually going to be 0. So entire value in this particular case is time value. So since the option premium is 2.10 and intrinsic value is 0, the time value has to be 2.10. So time value in this case is equal to 2.10, which is equal to the entire call premium, right? So this is what we are looking at. In the case of the put option, put premium is equal to maximum of exercise price minus spot price at the time of evaluation and 0, right? Plus the time value. So in this particular case, situation is a little bit different because we have $2.20 of option premium, as you've seen here, or 2.20 cents per 100, or we can actually write this down as $0.00220. In this case, E minus ST, which is 93 minus 9204. Remember, this is 1/10,000th of dollar, right? Plus time value. So here, this part is worth 0.000 0.96. So if you write this down as 0.00220 is equal to 0.0096, because this is what we get, right? 0.96 divided by 10,000. This is going to be something like this, plus time value, then we can actually calculate the time value as dollars 0.00. So time value in this case is equal to dollars 0.00124, which is only about 0.124 US dollars per Japanese yen. So the intrinsic value, time value can be calculated by this. Let me just move on to the next slide after clearing this up. So I'm going to erase these and let's move on to the next slide to see the calculations. So in this case, the data that we have is the spot price 92.04, exercise price 93. So the premium for American call is 210 and American put is 220. And the call option values, as we mentioned, is composed of intrinsic value plus time value. And we can calculate the intrinsic value as maximum of this difference plus 0 in this particular case. Since this difference is equal to 0, time value is equal to 210 cents per 100 Japanese yen. And actually, to make this correct, I should have specified that in here. That is actually equal to dollars 0.0021 as the time value. In true dollar terms, this is equal to 0.0021. In this particular case, again, the time value is 124, which implies that, so it should be time value is equal to 0.00124 dollars in this particular case, okay? So this part, 0.96, is the intrinsic value, and the remaining part, 124, is the time value. Just one quick note on the intrinsic value, the time value. Intrinsic value is the value that we capture from instant exercise of the option. In the case of a call, instant value that we get from the exercise is 0. So the entire value is embedded in the time value. Time value is the potential value of the option. That is, if the spot price goes beyond 93 and at the expiration, the value that we capture from the exercise at that time is given by this. So since the spot price at the time of evaluation is still less than the exercise price, option has no intrinsic value, but still there is a possibility that the spot price might exceed exercise price and we can actually get something out of the option. And the value that is attached to that prospect is this, that is $0.021 per Japanese yen. In the case of the put option, there is some value that could be captured from instant exercise of the option, which is 0.96 times 1/10,000. This time, something more that could be captured is embedded in this value, which is 0.0124. So the option already has an instant exercise value, but there could be more, provided that the spot price goes in this case, in this particular case, goes further down, which makes the option more valuable. And that prospect, that is the prospect that the option value is going to go down, has some substantial value in here, which is 1.24. So these are what the time and intrinsic value of the option are. So with this, we can move on to the next question. Again, let me clear these up because they carry on. So in this question, we have the spot price of the Swiss franc at 0.70, and the 6-month forward rate is 0.6950, and we are asked to calculate the minimum price that a 6-month American call option with a striking price of 0.68 should sell in a rational market. So what is the minimum price of this American call option should be with these parameters? So and also we are given the information about the US dollar interest rate. So euro dollar rate is essentially the dollar interest rate, which is 3.5% for a 6-month period in annualized terms. So in order to answer this question, we need to revisit some basic option pricing principles where we can actually establish certain lower bounds for the options. So for a call option, the maximum price that you would pay for an underlying is actually the spot price itself. So spot price is the sort of the upper bound for a call option. So you wouldn't pay more than the price of something to get the right to purchase that something. So the upper bound in the case of a call option is always the spot price itself. But what is the lower bound? Lower bound is a little more complicated, and it can be actually shown by using an arbitrage pricing relationship. So I'm going to skip the math and analytics behind that and directly use the formula that we have in the chapter, where we have actually a lower bound for an American call option. So the lower bound for the American call option is given as the maximum of the intrinsic value or the present value, the difference between forward rate and the exercise price, or zero. So the lower bound, meaning that minimum price that we would pay for an American call option should be larger than one of those three. Okay. So, for instance, if the spot price is less than the exercise price, obviously this is going to be negative. And if the forward price is going to be less than exercise price, this part is going to be negative too. So the only option that is left is zero. That means that the call option should be larger than zero. But if any of these are positive, then we will choose one of those. Particularly between these two, we will have to make a choice. In this case, let's check what is the deal in here. So the spot price exercise price difference is $0.02 in this particular case. The present value of the difference between the forward rate and the exercise price is actually smaller than this first one. So among these three, the largest one is the first one, which is the 0.02. That means that the call option should be at least 2 cents, if not larger. So if the call option is trading less than 2 cents, this would create actually an arbitrage opportunity, and somebody is going to exploit that arbitrage opportunity. So that means that in a rational market or a market with rational players, a call option cannot trade any less than 2 cents on in this particular case, Swiss franc. Okay, so with these parameters, it should not trade less than 2 cents. And this is completely analytical. All we have to do is just to plug in the figures and determine what the minimum price is. For the put, it is a little bit different. Here we are going to calculate the same bound for the put option. I'm going to directly go to the formula in here. Put option should be larger than the maximum of this time exercise price minus spot price, or exercise price minus forward contract price evaluated as present values calculated as at that time, and then 0. So in this particular case, this 0.68 minus 0.70 obviously is negative. This second one is also negative, and the only reasonable option is now that the put premium should be actually, this is a typo, it should be PA. American put should be larger than or equal to 0. So it has to trade at a price above 0, which actually there is no other way anyway. I mean, the option cannot trade any less than the 0. So in this particular case, lower bound turns out to be 0. Again, the upper bound for a put option is the exercise price. You would never pay more than the exercise price for a put option. But this is the lower bound that is given here. In this question, we are given the information about the a Swiss franc call option, and we are asked to value the call option by using the analytical model, which is a slightly modified version of the Black-Scholes formula in the textbook. The formula that is given in the textbook is one version. There are several versions of the same thing that we can use, but I'm going to stick with the description that is provided in the textbook. So, in order to be able to price an option, let me write this down so that we can be clear about it. So, an option, in this case, let's call it a call option or call premium, is actually a function of spot price. Let's call it S0, or forward price with at time 0 with T maturity. T implies the expiration of the option. Exercise price, time to maturity or time to expiration, interest rate for the domestic currency, interest rate for the foreign currency, and finally, volatility. Volatility, which is actually, or let's say standard deviation, which is expressed with this symbol S. So the call option is a function of either spot price or forward price, exercise price, time to expiration, domestic and foreign interest rates, and volatility. In the model that we were given in the textbook, the option price is given as a function of forward rate with T maturity, exercise price, time to maturity, domestic interest rate, because foreign interest rate is already embedded in the forward price. Remember, forward price is actually can be estimated by using interest rate parity, which is spot times 1 plus domestic interest rate divided by 1 plus foreign interest rate. So foreign interest rate is already embedded in here, therefore does not go into the equation directly, but it is actually a function of the call price is a function of that foreign interest rate as well. And then the last thing that we have is the volatility, which is S, okay? So we have these 1, 2, 3, 4, 5 variables which determine the value of the option. And we have been given almost everything in here. We do have the forward rate right in here, exercise price 0.68, time to maturity, which is 6 months. So T is 6 months or 0.5 year. Domestic interest rate is 3.5%, and the volatility, which is 14.2%. Okay, so we have all the data to calculate the option price. All we need to do is just to plug them into the model. So I'm going to erase this now and move on to the next slide to show the model that we are going to use to calculate the option price. So the model that we have here is actually an adapted version of the Black-Scholes model, or Black-Scholes-Merton model by Garman Colhagen. So that's why we call it BSGK model, where the call premium is calculated as forward rate. In this case, E is the exponent, and E to the minus R domestic currency or minus domestic interest rate times time to maturity. This is actually a discount factor. This is a continuous time discount factor. So which calculates the present value of the forward rate times N of D1. This N of D1 is a highly complicated concept, but you can think of this as some sort of an adjusted probability. So it is a probability that is interjected in here, minus exercise price. Again, the present value of that exercise price is calculated here. This E to the power minus domestic interest rate times T is actually a discount factor, times another probability, which actually is the probability that the option is going to be exercised. So this N of D2 is a standard normal probability, which measures the probability of the option to be exercised. So D1 and D2 are given with these relationships in here. D1 is actually equal to natural logarithm of the ratio of forward rate to the exercise price plus 1/2 squared volatility times time to expiration divided by volatility times square root of time. D2 is D1 minus sigma times square root of time. So it is an adjusted figure in here. So the data that we have allows us to calculate all the parameters in here, and we can calculate D1 and D2. The only other thing that we need to do is to evaluate these standard normal probabilities and I'm going to show you how we're going to do that. So the F0T is given as 0.6950, exercise price given as 0.68, time to maturity is 1/2 year, volatility, annualized volatility is 14.2, and the annualized interest rate is 3.5%. Just one thing to make it clear for you guys, everything that goes into this formula is in annualized terms, and we make necessary adjustments. For instance, domestic interest rate is 3.5% per year, but when we multiply it by half a year, it is actually a 1.75% interest rate. So it is adjusted within the model, but all the inputs are annualized terms. So is the volatility. Volatility is an annualized volatility. So when we plug these numbers in D1, we can calculate D1 as 0.2675 and D2 as 0.1671. Now, how we are going to calculate these standard normal probabilities based on D1 and D2? In order to do that, we are going to use a function in Excel. So there is a function called norms dist. When we plug in a parameter into this function, it gives us a probability associated with that parameter. So essentially, this is a standard normal distribution. D1 is one of the values on the x-axis, and there is a corresponding probability associated with that particular value, and that is given us with this equation in here. Let me try to explain this maybe a little bit more graphically. I don't know if I can do this, but I'll try. So if you can remember, a standard normal distribution is something like this, right? So my lines are not really good, but so this is the mean value, right? So D1, which is a value like this, around, this is 0, by the way. Standard normal distribution is 0 mean and 1 standard deviation. So the value, which is 0.26, should be somewhere around here, right? So the normal distribution function actually gives us the area below this. So the probability that is captured below 0.2675. Let's put it entire number in here. So this area gives us this probability, which is 0.6055, right? The other one, 1.671, it should be somewhere around here. And the area below that is 0.5664. So 56% below, let's say 0.1671, and 60% below 0.2675. So these are the probabilities that we get, and we plug them into the model in here. So N of D2 is actually probability that the ST at expiration will exceed exercise price. N1, as I mentioned, is a little bit more complex. It is a functional conditional expectation of the future spot price. So if we plug the numbers in, we get a price of $0.0351. Okay, so by using the option pricing formula, we get the option price, which is 3.51 cents per Swiss franc. Again, let's erase these, otherwise they're going to carry on the next slide. All right. So this is actually how we use the Black-Scholes formula. We rarely actually do this math or this calculation, but it is very easy to do it in Excel. But there are already spreadsheets with macros that can do the math for us, and I'm going to show you one of those in a little bit. The price of the put option is slightly different. We can calculate the put option by using the put formula, which is this version in here. As you see, there's a slight difference. Instead of using D1 and D2, we're going to use minus D2 and minus D1. And those probabilities can be evaluated by using the Excel function. Again, in this case, 0.39 for the minus 2.675 and 0.4336 for minus 0.1671. And when we plug these into the model, we get 2.03 cents for the put option. So in this particular case, put option turns out to be valued lower than the call option, in contrast to the previous example that we had just the opposite. So let's look at this question. In this particular case, we are going to use binomial model to evaluate the same option. So all the data is the same, but instead of using the Black-Scholes model or Black-Scholes-Grumman-Kohlhagen model, we are going to use binomial model to evaluate the option. If you remember, as I mentioned you, that the foreign interest rate is already embedded in the forward rate. So if you remember the IRP condition, we can actually solve the Swiss franc interest rate from this equation in here, which I did in here. So Swiss franc interest rate implied by this forward price should be 4.96%. So that is right there. So how we are going to solve the option pricing with binomial model. So let me first describe what are the steps that are involved to use binomial model to evaluate options. First of all, when we are given the time to expiration and the option volatility, we are given the binomial movements of the spot price in one period. So in the binomial model, we assume that the spot price can go up a certain amount and go down a certain amount. And how much the spot price can go up or down is determined by the volatility and the time frame. So given a particular time frame, we can actually calculate what is the up movement and what is the down movement. So up movement is given by e to the power sigma, which is the volatility times square root of the time. E, again, the exponential function. So this is exponential function, and this is the power of the exponential function. So we plug in these numbers in here, and we calculate, evaluate this exponent at 1.11056. This means that the spot price goes about 10.56% up at any given time, or roughly about 9% down within that time frame. So U, that helps us to find out the up value of the option. Oh, I'm sorry, spot price. Let me write this down just to explain what I'm trying to say in here. So according to the binomial model, we have a spot price. The spot price in a time frame of half a year can go up to what we call a up value, or it can go down to a down value. Okay, so up value is equal to S0 times U that we calculated in here, which is 1.156, and SD is equal to S0 times the D value that we calculated in here. Okay, so the spot price next period either will take this value or this value. This is the underlying assumption in the binomial model. So what happens if the price reaches up to this value? Obviously, if at the expiration option has this value, and given the exercise price, we can calculate how much it is worth. And if it comes down to this value, we can again figure out what the value of the option is given the exercise price. And then we can actually calculate recursively the value of the option right at this point. Now, in order to be able to do that, so essentially at this expiration price, we are going to have a up value of the call option, and then at this expiration value, we're going to have a down price of the call option. Now, we can calculate the expected value of the call option at time 0 by simply calculating the expected value of these two values. So C actually is going to be probability of an up movement times the value of the option on the upper branch plus probability of the option going down times the value that is calculated at the down movement. So that means that now we need the probability that the option will go up and the probability that the option will go down, which is actually 1 minus P. So in order to be able to price the option, we need to be able to calculate first UND and then probability of up movement and the probability of down movement, which are given as Q and 1 minus Q. The reason why we are not using the regular term P is that these are actually risk-neutral probabilities, which is some sort of mathematical construct. It is not the actual probability, but it is sort of a setup probability, but can be actually converted into an actual probability. And in terms of valuation, it doesn't really change the value of the option, whether we use these constructs or the actual probabilities. So the next step that we need to take in order to be able to value the option to calculate Q and 1 minus Q. And these are given actually as FD minus SD divided by SU minus SD and SU minus FT divided by SU minus SD in here. So the third step obviously is to calculate the value of the expected value of the options, these up and down values, and then calculate the present value of these by simply using the interest rate and the time frame. So that's actually the term that you see in here. Okay. So that is the strategy that we are going to use, and we have all the formulas in here. We already calculated the U and D in here. The next thing that we need to do is just to calculate Q and 1 minus Q, and then simply execute this formula. Let me again clean this up. So the Q, which is the up movement probability, given the parameters that we have, is 43.94%, and the down movement is 56.06%. So the call value in the upper branch when the price goes up is 0.094, and when the price goes down, which is actually going to be below 0.68, therefore it has zero value in here. And when we plug in the numbers in the model in here, 0.04394 times 0.094 plus simply zero, and then discount that to times zero, we get 0.04. So when we use the Black and Scholes formula, which is much more accurate than this one, we got 3.51 cents. Here we got 4 cents. There's a discrepancy because the binomial model is much less accurate for large intervals. If we actually calculate the prices for, let's say, for 1 day instead of half a year, the binomial price and the Black and Scholes price are going to be very close to each other. Or if you do it even for shorter periods of like hours or minutes, they will be almost identical to each other. But when you use such a large time frame, binomial is not as accurate. So there is a discrepancy because of that. And this brings me up to the last issue that I want to talk about, which is using an Excel macro in order to value this option. Here, I have used this. Let me clean this up. I've used this Excel sheet in order to calculate or value the option that we used in our example. So spot rate is 0.70, exercise price 0.68. The domestic interest rate is 3.5%, which is the US interest rate. In this model, we require also the foreign interest rate, which I already calculated as 4.96. I showed you earlier. I extracted from the forward price. The time frame is half a year, and volatility is 14.2%. When we use the pricing formula, actually we get 3.5 cents, which is very similar to the calculation we had earlier. So the option, the call option is 3.50 cents, and the put option is almost 2 cents. We both calculated these earlier. So this is the use of a spreadsheet to calculate the option price. I'm going to show you maybe more of this later on when we meet. So I will stop in here and we will follow up.